Hello friends, is the correction over? Is the downward phase in the market finally over, and are the markets going to continue their journey on the way up? This is a question which I'm sure is on the top of the mind recall for every trader, as it is with me. And in this video, I'm going to attempt to help my viewers answer this all critical aspect. My name is Vijay Bhambwani. I've been trading these markets since 1986. 36 years is what I've spent in this market, and I want to help my viewers make good money out of their trades. Let's rush right in. Coming up on your screen is your weekly market roundup window, which tells me that it was the banking space that led the rally upwards. And the Nifty 50, of course, rose, but a tad lower. What really triggered this optimism was a decline in the US dollar index, the Dixie, which fell 1.38%. Now, a falling US dollar, I've explained to you in many earlier videos, is positive for emerging markets, including India, because our landed imported goods cost is lower. And India is a net importer since independence. And particularly, fossil fuels, natural gas and crude oil imports become slightly cheaper, and since these are inflationary products, our inflation is also curbed. So that gave us a relief rally. Now, since the US dollar index was weak, it was expected that commodity prices go up, which they did. Gold and silver went up, silver almost double of gains of gold, and crude oil also edged up a little, but it was natural gas that flared up because the Russians are still curbing supplies to those countries which are not paying in rubles. So that remains a geopolitical bargaining chip as of now. The US dollar versus the Indian rupee rose a 0.25 percentage point, but it wasn't as bad as it was feared and what was seen last week. Now, bond yields went up slightly. Now, that was 3 basis points or 0.41% on the base. So, nothing really earth-shattering happened over there, which is why the banking space saw optimism in, and it's reflected in the Bank Nifty. The biggest trigger, as far as I'm concerned, was the NSE market capitalization rose 5.5%. Now, do remember, I told you that if the NSE market cap has lost more than 4.5% for 4 consecutive weeks, or maybe 5 if you want to be really safe, then a bear market has typically ensued. And in the week before last and last week, put together, we lost a little under 10%. All right. So a gain of 5.58% in market cap is like a shower of rain in the arid and hot desert sands. This was very, very welcome. This tells me that there's short covering taking place at lower levels, and the possibility of a technical pullback is in the offing. The market-wide position limits went up to 27.73%, but do remember, risk appetite still remains low because it's way off the 30 to 33, 34% that we've seen up to December. The overseas markets remained under pressure. As you can see, the Dow lost a little under 3%, the Nasdaq lost 4.5%, and a very broad S&P 500 lost 3%. Now, the chart of the US Dow Jones Industrial Average tells you that the death cross, which I told you in the last few videos, the 50-day moving average below the 200-day moving average remains in place. But the last candle of Friday shows a bullish hammer, which means a temporary resistance to further declines. Now, can a pullback relief rally occur in the Dow? Remember, I'm saying a relief rally, not a reversal. Yes, it's very possible that the Dow might just attempt to go all the way up to 33,000, maybe even 33,250 odd levels, and then we could take a call. So a pullback rally can indeed occur in the Dow. Now let's see the Nasdaq. Nasdaq was earlier than the Dow in reporting a death cross. Here again, you're seeing a hammer, but not a bullish hammer, a bearish hammer. Nevertheless, the indications are that there is a resistance to big ticket declines. And here again, a pullback rally to 13,200 odd levels might just be seen, which is a good 1,400 points on the Nasdaq. The S&P 500, like the Dow itself, has shown a death cross but showed a bullish hammer on Friday. Here again, watch the 4,200 levels as a potential. I'm using the word potential pullback rally point. Now, friends, I wanted to basically record a capsule in this weekly market outlook video in which I would have explained to you what a phalanx market is. But that video is turning out to be a little too long to be used as a module in this video itself. So we've decided to spin that video as a separate video altogether. Do watch out for that video. The thumbnail is visible on your screen. We'll be uploading that video very, very soon. And I promise you it'll be well worth the time that you spend watching that video. So let's proceed ahead with our weekly market outlook. And on your screen now is the market-wide position limit, the total positions that the traders have created as against what SEBI allows. So we've reached 27.73%. And a rising MWPL is very natural because till the third week of the derivative cycle, traders do tend to raise their exposure levels. But the 30 and 32, 33, 34% that we used to see up to 4-5 months ago is a remote cry. So the two marshmallow traders, these are traders who take their positions overnight. The marshmallow theory is explained to you in this video. The URL is in the description below this video, in a pinned comment below this video, and will appear as an end screen also at the end of this video. So don't worry, we've got you covered there. So the two marshmallow guys are definitely showing lower risk appetite, and the weekly chart of MWPL validates my point that since the last 5 expiries, we are yet to see a peak of 30, 32, 33, 34% in the MWPL before it falls on expiry day. So do keep your ears to the ground on MWPL. I update this metric every single day on my social media account. So do connect with me. We'll get conversations going. We can help each other become better traders. And I can help you arrive at a decision whether the corrective decline has run its course or not. Now, the index and stock futures turnover tells me that the turnover on individual stock futures has risen on a week-on-week basis. Now, that tells me that the one marshmallow guys, now these are traders who are intraday players. They do not roll their positions to the next day. These are lower risk appetite traders as compared to the two marshmallow guys, but they are showing, relatively speaking, as compared to their own actions, slightly higher risk appetite because their turnover in stock futures is higher. And stock futures tend to be more volatile than index futures. So they are showing some aptitude towards taking higher degree of risk. Where the index futures turnover is concerned, that has fallen on a week-on-week basis. The same is confirmed by the weekly chart of the index and stock futures turnover. Do remember, this is a cumulative figure of 3 derivative expiries, which is May, June, and July. I now take you to the two marshmallow theory appetite of risk. Now, this gauge is called the basis. What does it mean? It means the premium or discount to the spot enjoyed by the futures. Now here, both the Nifty and the Bank Nifty futures are trading at a discount to spot. Why does this matter to you? Why should you bother? Because if at all short sellers are selling at these levels, it's like paying a penalty. Since you're selling it at a discount, it's like paying a penalty. In spite of this penal negative cost of carry, short sellers are still selling, which tells me that the up move that we've seen on Friday and prior to that, that surprise rally which you saw on Tuesday last week was a corrective advance. It was not a trend reversal. Of course, this is my opinion based on statistical and chartical evidence. Feel free to take a call on your own self. I'm merely providing you my point of view, of course, and I do reserve the right to go wrong once in a while. Now, the weekly basis chart tells me the same thing, that the basis has been plunging since the last 1 month, 4 weeks, and it's now in negative. Not only is it in negative, but the basis is at the lower end of the 20 weeks, that is 4.5 month range. Now, this tells me that risk appetite within buyers is fairly low. You might be basically seeing technical pullbacks. As a matter of fact, there is a separate video that I'm recording about why bear market rallies tend to be very, very vicious and tend to surprise traders. Do watch out for that video as well. I've got a lineup of a lot of videos that will, I promise you, transform you as a trader. So do keep connected, subscribe to this channel, and you've got a lot of goodies coming your way. So the risk appetite, coming back to the basis chart of the week, tells me that the corrective pullback rallies notwithstanding, actual boots at the ground kind of action, people who are actually in the market and trading in the market are still skeptical. Now for the advanced decline ratio. Now this is a one marshmallow metric. Like I told you, you can refer to the marshmallow theory video to understand the concept. It's a behavioral technical analysis concept. The advanced decline ratio has jumped to 4.74, which means for every 100 losers on Friday, there were 474 gainers. Now, this surprise blip is way too high. Will it last? Can it sustain? Now, this is a question that we've faced in the past. Do remember when I take you through the weekly chart of the advanced decline ratio in the next frame, I had told you that these lofty levels invariably tend to prove unsustainable. And sure enough, on the weekly chart, you can see in the past, there were 2 occasions when the advanced decline ratio had actually jumped even higher at 5.31 and 5.01 and had collapsed immediately, which proves my hypothesis that this is a bear market rally as of now. Can I change my view? Can this be termed as a beginning of a bull market? Yes, it can, provided weight of evidence, statistical and chartical, tell me that it is time to become a bull. But right now, early days yet, so I'm not really going out there and telling you that it's a beginning of a new bull market. Give it some more time. Let's play safe. Now for the impetus. What you are seeing on your screen is a telling story. On Tuesday, when the market jumped up, I wrote in my social media post that I would expect a mean reversion and a decline. And sure enough, on Wednesday, after beginning on an optimistic note, the market dovetailed. Why? Because the impetus was falling throughout the time that the Nifty and the Bank Nifty were attempting to rise. And in spite of the fact that both the indices have logged gains on a week-on-week basis, look at what the impetus is telling you. Each and every day of the week, the impetus has fallen, which means, statistically speaking, this is not a confirmed bull market. This is a technical bounce back, but this bounce is going up on skepticism. Let's shift you through the weekly chart, and you can see there's a very steep fall in the impetus on both the Nifty and the Bank Nifty on a week-on-week basis. Now, unless the impetus turns positive, and significantly so, along with the indices rising, along with the advanced decline ratio and the basis rising significantly, I will not go out there and buy aggressively. I might just go out there and become an intraday trader because I am a micro trend trader. I prefer to keep my positions open for less than an hour preferably. I might go out there and become an intraday micro trend trader buy, but I'm not going out there and keeping overnighters as long positions. Now for the LWTD chart. Now this is a daily chart, so this impact will be felt and seen only for Monday. All right. Now the Nifty percentage gain loss, as I had explained to you on social media, this is not an absolute number, but a percentage gain or loss, because that facilitates a better comparison on a correlation coefficient chart itself. So the Nifty percentage gain loss has jumped to the high of this 20-day period, whereas the LWTD has fallen to a little over 0.5% in the negative. That tells me that on Monday, there is a fair probability that the market might witness some heaviness on the upside. Higher levels might just encounter profit taking from weaker hands, short-term traders, or even some amount of delivery-based selling. Now for the week-on-week chart of the LWTD, this is extremely pronounced. The Nifty percentage gain loss is at the highest in 20 weeks, 4.5 months. But the LWTD is in the lower end of the same period's range. So there is a pull and push. The Nifty wants to pull itself up. The LWTD saying, hey, there's going to be a dead weight tied around your back while you swim in the ocean. So this is still a cause for concern. Another reason why I'm not buying into a complete bull market reversal hypothesis. If you are interested in knowing one of the main reasons why, don't skip the chapter on bond markets. Do not, because this is the crux of my hypothesis as to why it's a bear market corrective advance rather than a complete bull market beginning. Now for the four market participant types, we begin with the FIIs who've increased their index and stock futures net long positions on a week-on-week basis, and they are basically showing optimism. Where DIIs are concerned, their index futures net shorts have increased, so their outlook on the indices is defensive, but they've squared up their individual stock futures shorts very, very marginally. So there they are not all that cautious. Where prop traders are concerned, look at the humongous amount of unwinding of long positions, both in the indices and in individual stock futures. Why would you care about prop traders? Because these are brokers' own trades. They know who's buying and what and at how much and what price, in what quantity. So these guys are second best to insiders. And these quasi-insiders are actually unwinding their long positions. That's something that you need to be very careful about. Now for the last and the most important category of traders, the retail participants, people like you and me. These guys have been doing all the heavy lifting since the last 1.5, 2 years. They've propelled the markets to new highs and taken euphoria to new levels not seen in the history of Indian stock markets. And they are holding the largest amount of long positions in the market for any category whatsoever. And they are unwinding. So the size of their long positions is so huge that if this unwinding was to accelerate, the market could come under severe amount of selling pressure. So this is a figure also that you need to watch on a day-on-day basis. So all in all, the weight of evidence of all the indicators that I've shared with you so far seem to tell me that it's not really a bull market. Now, the in-house indicators done, I now come to the bond market, which is, I told you, the crux of my hypothesis as to why this is a bear market correction rather than a bull market beginning. Now, you see, the RBI's MPC, the Monetary Policy Committee, is meeting in early June to determine whether there should be another round of rate hikes. If at all rates are hiked, it is known that the markets will take it on its chin and possibly correct lower. What if the market was to be taken up before the rate hike meeting and the rates are hiked? Since there is euphoria in the market, there is a lot of exuberance, there's a lot of ecstasy, there's a lot of expectation and feel-good factor. If rates are hiked, the market don't really fall all that much. Is that possible? Very much so. Extremely possible. So my gut feeling is, and I tell you this is a gut feeling. And why is this gut feeling? It comes from experience. Experience that gray hair gives you after being in the market for 36 years. My gut feeling is the markets are being prepped for another rate hike. Optimism and euphoria is ruling the roost. And when rate hikes are actually implemented, you might say, okay, I'm going to brush this off. It's all right. It's a bull market. And the markets, the headline indices are going up. So there's nothing to worry. All right. And look at where the benchmark bond yields are. They are still in the upper end of the intraday, the 6 monthly chart that you're seeing on your screen. So that tells me that the bond yields are not seeing any kind of a relief from either inflationary concerns or even expectations of a further rate hike. So do be very careful out there, my friends. Don't get too aggressive where leverage buying is concerned, or if you are holding long positions, averaging these losing long positions is concerned. Now that can be a little bit of a problem, and not just a little bit. Little bit is a metaphor. So be very, very careful. Volatility is extremely high. This is not a volatility level that I'm comfortable trading with. Ideally speaking, I would like to cut back on my traded exposure, keep my stop losses tight, and trade extremely cautiously. And if at all, I do have long positions left over, which I don't. This is a hypothetical situation. If I do have long positions left over as residual carryover long positions, I would feel uncomfortable. So my bias is definitely towards caution rather than accepting this as a bull market at face value. Now, my friends, the bond market segment done, I now come to the US dollar index, a very critical component for emerging markets, including India, because not only does our imported inflation depend on it, I told you how the dollar impacts our landed cost of imported products, particularly fossil fuels, oil and gas, but it also impacts on our overseas debt. The amount of money that both the government and individual companies have borrowed from the overseas market, the interest payment and the repayment become a little more difficult when the dollar rises. So I come to a very critical aspect of this market. Don't let anyone tell you that you should be ignoring this segment, which you can't. So mercifully for us, the US dollar index saw a marginal decline on a week-on-week basis. As you can see on your chart, the index has fallen 1.38% and it fell on 3 out of 5 trading sessions last week. And remember what I told you in my recent video, that the price had run far away of its 25-day exponential moving average, which is a proxy for a 1-month holding on cost of an average bull. So some amount of profit taking and a retest of that 25-day exponential moving average was possible. There you are. That's exactly what happened, and the price has bounced from its 25-day exponential moving average. On the weekly chart, what you can see is a sizable, a bearish candle which engulfs or overpowers or overshadows the body of the previous bullish candle on a weekly basis. That tells me that the bears have hit the bulls with significant amount of force, and the price, although staying above its 25-week exponential moving average, which is a 6-month holding on cost of a bull, the medium term outlook might remain optimistic, but mean reversion or retracement of the price to come and test the 25-week exponential moving average is still an open possibility. So can the US dollar index come back to test the 100 level over a period of time? Hypothetically, it is possible, which could be one reason why you could see a bear market rally gain ground in India and other emerging markets in the coming days. Now, last week, I advocated a range between 105.95 and 102.95. That was violated marginally because the low was 102.69, marginally lower. In the coming week, I expect intra-week range between 104.55 on the upside and 101.50 on the downside. Do keep eagle eye on the US dollar index because this determines our inflation and other metrics. Friends, the US dollar index done. I now come to the Bank Nifty, which was the star of last week because it rose 3.49% as compared to 3.07% of the Nifty 50. And as you can see on your screen, this index gained on 3 out of 5 trading sessions and outperformed the Nifty by a good margin. The 2 green bullish candles on your screen last week were sizable ones, and that is what is responsible for keeping this index so buoyant. Do remember that the price still remains below its 25-day exponential moving average, which is a proxy for a month-long holding on cost of an average bull. So it is still a technical rebound or a retracement rally rather than a complete trend reversal. There is an open gap, as you can see on your chart, and the possibility of the open gap can always be kept alive as being filled at a later date. So can 35,000 levels be overcome? I would not rule it out at all in the coming weeks. Do remember that the RBI's Monetary Policy Committee meeting, the outcome of which will impact banks the most. So this is one sector which will be extremely sensitive to any interest rate expectations and or the final changes in those rates. All right. And coming to the weekly chart, what you are seeing is that the low made in March on the Bank Nifty at slightly higher than 32,000 levels held for now. It's been defended by the bulls, and a good sizably prominent bullish candle has been logged on the chart. And what we need to see in the coming week is the intra-week high of 34,655. The market needs to trade sustainably above that level for a rising tops and rising bottoms formation to occur. The price remains below its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook still remains cautious for now. In the week before last, this index was at number 5 on the most volatile counters list. Last week, it fell one notch to go to number 6, which is a welcome sign. Although it's open to debate as to whether the Bank Nifty's volatility fell or the individual stock futures volatility rose. I belong to that camp which says the individual stock futures volatility rose because the market was in a yo-yo mode. Last week, I advocated a range between 34,900 on the upside and 31,300 on the downside, which held beautifully well. In the coming week, I expect a range between 36,050 on the upside and 32,500 on the downside. Friends, the Bank Nifty done. I now come to the Nifty 50, the lowest impact cost instrument on the NSE derivatives segment, and also the most liquid to enter and exit. As you can see on your screen, that the daily chart of the Nifty 50 tells you that it fell on 2 out of 5 trading sessions. Those falls, though small, were with a gap, so they were prominent, but the two bullish candles were prominent. You can call them power candles because of their sheer size. Is the 15,750 level a double bottom or a bottom of some sorts? I would call it a swing low for the want of any other word, although I'm not calling it a hard bottom as yet. So as a swing low, yes, I need to watch that. The price remains below its 25-day exponential moving average, which tells me that the month-long holding on cost of the bull still remains higher. And that means overhead supply will continue, which explains to you why the basis is negative. And the window that is open as a gap between 16,650 odd and 16,500 odd, I'm giving you I'm giving you approximate levels. That gap might just be attempted to be closed, which means the probability of these levels being tested still remains open. But like I've explained to you earlier, I still belong to that school of thought which says, I don't mind if the market goes up, but I'm not betting the bank on a complete trend reversal. I'm calling it a technical rebound and a bear market rally. Going to the weekly chart on your screen, you can see that the candle that is made, the bullish candle that's made in the last week is a prominent one. It's a fairly large one. And the high of this candle at 16,400 levels in the spot needs to be overcome on a sustained trading basis next week if the bulls are to have any kind of a reversal being put into place. Do note that the price remains below its 25-week exponential moving average, which is the 6-month holding on cost of an average trader. That means the medium-term outlook still remains cautious. The moving average itself is turning lower, which is another sign of concern. Do remember, markets can always bounce back, reversals can occur, but at this point in time, it's a little premature to presume a reversal. Now, in the week before last, this index was number 9 on the most volatile list on the exchange. It remains there. It still remains at number 9. It's not because the volatility of this index is constant. It's because the volatility of stock futures have gone to the moon. And last week, I advocated a range between 16,425 on the upside and 15,100 on the downside. Do note that the resistance was at 16,400 exact. That's 25 points below the level that I advocated to you in last week's video. This is all thanks to the work that IBEX does on our behalf. IBEX is our in-house statistical trading model. We are working on it. It's comprising 6 modules. Work is just ending on the 3rd module, 3 more modules to go, and it'll cover bonds, commodities, forex, equities, derivatives, the works. So friends, even though the Nifty has stayed between the levels that I advocated, it does not mean that you throw caution to the winds. The coming week is likely to see a range between 16,900 on the upside and 15,625 on the downside. But volatility is likely to jump up. And that is my biggest concern. Volatility being high helps no one at all. It makes your life difficult as a trader. Although the indices have gained 3% on week basis, tell me or ask yourself, has this week been a very easy week to trade? The answer is no. Gap downs, gap ups, power bullish bars, and then gap downs again. It's keeping you on the edge. This is what is likely to occur even in the coming few days. So be extremely careful out there. Trade light, widen your stop losses if you have to, but positions have to be regulated extremely carefully. Friends, the index section done. I now come to the most popular segment of this video, where I give you 5 stocks, high beta, high impetus, which you need to take small exposure, wait for large price moves. 5 stocks that are low beta, low impetus, which you take a big exposure, wait for small price move. These are for scalpers, intraday scalpers. Now, this list is valid only for Monday, and every day I'm going to put this list on our Telegram channel. We've started a new Telegram channel. Please do connect with us on that channel and subscribe to it. We basically are going to focus more on Telegram and also on WhatsApp, but WhatsApp has its own limitations, so Telegram is going to be the focus. And every day, starting from Tuesday up to Friday, this list will be updated on our Telegram channel, so you can view that in real time. Here it goes. On Monday, I expect Abbott India to be number 1 where high impetus stocks is concerned. Number 2, Hindustan Aeronautics. Number 3, TVS Motors. Number 4, Apollo Tires. Number 5, HCL Tech. Where low impetus stocks are concerned, the list is led by ABB at number 1, number 2, Dabur, number 3, Nestle, number 4, Deepak Nitrite, and number 5, Cholamandalam Finance. Friends, the hierarchy of this list will change from day to day, hour to hour, which is why I say that I need to update it every day, which is why you're going to see it on Telegram. Friends, in the coming week, please do take extreme caution and wait for my video about a phalanx market and why bull market rallies are so vicious. This will help you understand what is happening in the market and whether Vijay Bhambwani is going wrong in his hypothesis, because the market jumped up on one trading session on Friday against his reading of the market. Friends, before I bid goodbye to you in this video, a small reminder. If you liked what you saw, please click like on this video. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad or ugly, I always look forward to hearing from our viewers in the comment section, and I'd love to have your feedback. Also, help me reach out to smart traders like yourselves by referring my video to your family and friends. Thank you for your patience and being with me in this video till we meet in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Bye-bye for now.